This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Oli's picture saying looking for the downloads. Now, Eric, let's start with crude oil and the EIA inventory.
EIA printed drawdowns across the board, and they were big ones. Crude oil drawing down 4.6 million barrels. Cushing, Oklahoma drawing down 0.6 million barrels. Gasoline drawing down 1.6 million barrels. Distillates drawing down 3.3 million barrels. That's a net petroleum products drawdown of a massive 9.5 million barrels. Meanwhile, U.S. production ticked back up 100,000 barrels to 13.4 million barrels. That's an all-time high on the weekly data series, and let's cross our fingers, maybe it's the beginning of a new trend. Can I hear 13.5 instead of 13.4 in coming weeks? Let's see what happens. But even that gigantic inventory draw wasn't enough to keep the market from selling off after inventory to retest the early August lows at a 71 handle on WTI. While the flat price is clearly suffering, we're still in a reasonably steep structural backwardation. So the physical market is sending a very different signal than the flat price. I still think geopolitical risks are underpriced by this market. But frankly, I've said that many times before, not to mention losing money betting on that view, only to be proven wrong, at least for now. But longer term, I really do think that we're headed higher on energy prices.
Yeah, the price action has been incredibly weak, remaining below its 50-day moving average. All little rallies are immediately sold into, but we are approaching very key support lines all the way through 2023 and 2024. This $68 to $72 area has been where all of the short-term support lines have come in. With us in this oversold state and approaching these levels, it will be likely that we're going to at least get a reaction and a support line holding on the first test. What will be far more interesting is if that can establish a bottoming formation there throughout the remainder of August and early September, and whether or not that could be a turning point. At this stage, we're just going to be watching how the price action behaves along this key support line while it's still in this primary downtrend. All right, let's move on to the equity markets. Nick, I want to talk to you about the levels. What are you watching here on the S&P?
Right now, spot price on SPX is approximately 56.30, and we have an implied move for the September 20th monthly OPEX of plus minus 170 points. Therefore, we have an upper implied move of 5,800, which would mark new all-time highs, and we have a lower implied move of 54.60. Right now, we have key resistance at 56.70 all-time highs and key support at 5,500. I'm inclined to think we see some more chop, perhaps a smaller move to the upside into the middle of September, but I'm not overly bullish right here. I think we're going to see more of a kangaroo market into the election cycle.
Yeah, the S&P 500 had this slingshot rally from a very oversold state, now approaching its previous highs. There's very little asymmetry in pressing a new long, especially when we have trigger points such as NVIDIA's earnings coming up and Jackson Hole tomorrow. We're going to see whether or not that spurs maybe a little bit of a distribution cycle. The one thing I would say is that the market has really neutralized the sell cycle. It would take a lot of technical damage in order for us to turn the trend back down. And so it's very likely, even if there was a 150 S&P point pullback, that it's very easily going to find support at that 5,500 level you just referenced, and we stay stuck in a trade range until some of the bigger news events in September. Well, let's move on here on page 4. I have the QQQs. What levels are you watching here on the Nasdaq?
Right now, spot price on Qs is approximately 484, and we have an implied move for the September 20th monthly OPEX of plus minus 20 points. Therefore, the upper implied move is at all-time highs of 504, and the lower implied move is at 464. Right now, we have key resistance at all-time highs at 504 and key support at 465. Right now, as I said before on SPX, I'm not overly bullish on the tech. I think that there are some names that make sense to go long. For example, PayPal and Google, I'm long on right now, as well as Palantir and Shopify. However, I'm trimming my positions on the latter two. But I do think we see more of a chop market into that election cycle.
On page 5, I have the volatility index, and obviously we talked last week about that huge spike and pullback. But what's interesting is that we're now finding a little bit of a higher elevated level on the VIX, which is consolidating here at the 15-16 level. What are you watching here on the VIX?
So with the VIX at a 16 handle approximately, we can expect to see top to bottom intraday moves of about 1% on SPX, and insurance getting a bit cheaper into the election. However, it's still elevated from where it was a few weeks ago. I think that Powell's commentary tomorrow for Jackson Hole will be very key in determining where we go next, as well as if we spike on the VIX or not, which would correlate with the downside move in broad markets. But overall, I think we're going to see business as usual, where we see more chop and range between the 14 level on the VIX and about 20. If we do spike above 20, it's likely we see a spike higher to 25 to 30 perhaps in a very, very fast window, kind of like we saw a few weeks ago. Moving on to page 6, we have that US dollar index. What are your thoughts here?
Wednesday's close below 102 on the September Dixie contract seems to confirm Louis Gave's view that we've entered a new bear market in the dollar. But there are so many variables in play that anything's possible, and another big geopolitical escalation could easily trigger a flight to safety rally for the dollar.
Yeah, I find it very interesting where the dollar is right now. As we approach the 2023 and 2024 lows on the dollar index, we have a very oversold dollar. The euro's at its a key overhead resistance. The pound's at its previous highs. The U.S. dollar yen just did a fib retrace retest along its lows. There's a lot of reasons why the dollar may react off of this support line and offer even 1 or 2 points on the upside. The bigger question to what you're suggesting there as well is that when will we have a more meaningful turn in this trend, and will we have one of these flight to safety events occur, especially going into the September-October period? Right now, all we have is a very oversold market that's in a primary downtrend, trading right into major support. So let's see whether or not we get a bounce here.
Now on page 7, we have that gold futures chart, which is making new all-time highs. What are you guys thinking here?
Well, the bull market rages on, but by any reasonable measure of technical analysis, there's a very strong argument to be made that we may have just hit a swing high at 2570 on Tuesday. Now, that was a perfect test of trendline resistance. The slow stochastics are well into overbought territory, and a lot of analysts' longer-term targets have already been met. I happened to be sitting in front of my screen watching live when we briefly traded over 2570 on Tuesday, and I was sorely tempted to take some profits in expectation of at least a normal swing correction back down to, 2475, 2485, in there somewhere, where I thought I could buy back a larger position than what I took off the table. But frankly, last time I tried to get fancy and trade in and out of my gold position, I shot myself in the foot. And a big geopolitical escalation in the Gaza or Ukraine conflicts could easily take this market much higher, regardless of the fact that we're already in overbought territory. So I'm standing pat. I don't think this bull market is anywhere close to over, but there are plenty of good reasons to brace for a $50 to $100 move below Wednesday's close, simply as a normal price swing. If we get that correction, I'll definitely be adding to my longs below 2,500.
Yeah, Eric, all of the highs from April and May occurred around that 2450 area, and that's also where that 50-day moving average is. After this little impulse higher, there's obvious room for gold to have these kind of $50 pullbacks like you were suggesting, but anything that falls back towards there, you have to assume is going to be a buy on dip opportunity. We're going to be watching as well whether or not this trend can continue towards the different measures targets, which are all lying in that 26 and 2700 level on the upside. The key takeaway, though, is that gold has been one of the few things that has remained in a decisive bull trend. Higher highs, higher lows, well accumulated, well defended, never really pulled back deeply when many other commodities were going through substantial corrections. And that generally is a sign of good accumulation. And I think that you have to respect that this prevailing trend can stay stay dominant in the months to come.
Now, moving on to page 8, we have that uranium chart. Eric, what are your thoughts here?
Well, the market is holding its bounce off the August 5 lows, but frankly, the recovery is anything but robust. I stand by my conviction that the fundamentals couldn't be better. Also, from a seasonality perspective, we've got the World Nuclear Association conference coming up September 4th through 6th, and that also has historically been a bullish catalyst. But there's also plenty of room to make the argument that the charts are still looking pretty weak from a technical perspective. I also see a couple of downside risks that I don't even know how to gauge because there's simply no precedent. One is the possibility of a tactical nuclear weapon being detonated in an escalation of either the Ukraine or Gaza conflicts, and the other one is the possibility of either the Kursk or Zaporozhye nuclear power plants. There's one in Russia and one in Ukraine. Either one of those being bombed or otherwise compromised by military action in a way that results in some kind of leak of radioactive contamination. Now, would either of those events cause the public to freak out and decide nuclear energy is bad just because a nuclear power plant was damaged in a military action or because a nuclear weapon was detonated that had nothing to do with nuclear power? Well, there's clearly no sane logical reason for anyone to reach those conclusions. But frankly, there was no sane or logical reason for the anti-nuclear sentiment that occurred in the wake of the Fukushima incident. And that cost us a full decade of very strong anti-nuclear sentiment. So who knows what's possible if one of those risk events were to eventuate? On the bullish front, China announced about a dozen more reactors this past week and continues to lead the world in the nuclear renaissance. We in the West need to catch up. And again, there's more about that in my Substack post, which is linked in your research roundup, or you can find it at erictownsend.substack.com.
Yeah, the distribution cycle is relentless here, just continuously lower highs, lower lows, staying in a primary downtrend. At some point, this will trigger a new buy signal, but technically there is no sign of it right now. We're watching closely. I want to touch on a number of other commodity charts that Oli was referencing. On page 9, I have this copper chart, and what we have was a very oversold market that has now bounced, but the primary trend is still down. And while we probably are much closer to the bottom than we were to the top that occurred back in May, I still think there's going to be a prolonged bottoming formation. I would not be shocked here if we retested $4 or lower numerous times, establishing a base that might take the entire month of September to really form. At some point, there will be a base that we can look for a new bull opportunity to form, but probably at this stage, we may be waiting all the way into the fourth quarter for a new buy signal. I wanted to end with on page 10 and 11, I have the chart of wheat and soybean, and just as an example of just how persistent the downtrend has been in this ag space. At some stage, these oversold conditions are going to be given a new catalyst for a reversal. But right now, this is a good example of what's happening in the entire broad commodity basket. It's just been relentless selling. At some point, this is going to be a phenomenal opportunity, but there really is no technical signs of things like the bottoming formations, double bottoms, reversals, patterns of breaking descending trend lines. We're going to eventually see that, but it's no sign right now. And so again, this is probably going to take the entire month of September to establish key bottoming formations before we can get some new buy signals.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.